Welcome to our live stream to do with the Federal Reserve's monetary policy decision. And the plan is, I'm just going to quickly summarize what the Fed did and what I think about it and what I think it means for markets as well, not just in the US but elsewhere. So let's start off with the actual decision itself. So no surprises here. The Fed didn't change the policy rate. Markets didn't expect they would, and they didn't. And it's often the case that they do what markets expect, and there's no exception this time around. The big change, I'd say, in terms of policy was the rate at which they're shrinking their balance sheet. And this is the kind of second part of their policy toolkit, the second major part beyond interest rates. Now, previously, what they were doing is, as the bonds in which they bought, the US treasuries, but also the mortgage-backed securities and agency debt, as they matured, they were reinvesting the principal and coupon payments back into those investments. However, what they're planning to do is to, firstly, and surprisingly, I think, take the MBS, which are maturing, and feed those into the treasury holdings. And then the treasury holdings, the rate at which they reinvest in, there's a cap above which they kind of reinvest. They're going to slow the rate of that from 60 billion a month down to, I think it's 40 per month. So overall, the rate of reduction of the balance sheet is going to be considerably slower. And that's despite the fact that they're kind of siphoning the mortgage-backed securities into the treasuries. So I think it's going to be at about $40 billion a month, the rate of overall shrinkage of the balance sheet, down from 95, I guess, because it was 60 for treasuries, 35 billion a month for mortgage-backed securities. So that's a big change in terms of the rate of balance sheet shrinkage. What was also clear this time around is that Powell actually said he doesn't think that the next move from the Fed is going to be a rate increase. So that's clearly off the table, or as much as it ever is, given that they're data dependent. But that's clearly his opinion. He doesn't think it's going to be a rate increase, which some people have been talking about. But what he also did, which was interesting, was talk about pathways, and I'll come on to this. And this is perhaps a new way of communicating their monetary policy. Talk about reasonable hypotheticals for the path of the economy and what the Fed's reaction would be to each of those. But it doesn't look like it's going to be a rate cut anytime soon. That was clearly part of the message. But at the same time, it's not going to be a rate increase, which would have been a big shock, I think, if the Fed had to backtrack. So overall, no surprises in terms of rate. A pretty big surprise. I think people knew that they were going to slow down the shrinkage of the balance sheet, but they slowed it down more than expected. And clearly guidance that it was unlikely they're going to raise rates from this point. And they still think that monetary policy is sufficiently restrictive where they are now. So let's just start off with the expectations. So this is what the market expected as of this morning. And I always like to do this. In the morning of the FOMC, I take a kind of snapshot of the futures market for the federal funds rate, and I did it this time as well. Let me just shrink my head down a little bit. Here we go. So this is as of last meeting. So this was as of March of this year. So March the 20th, that previous meeting, and this is what markets were expecting of the morning of the meeting. They expected the first rate cut would be this year. In fact, next month. They thought it would be for the 12th of June meeting. And then there'd be a cut every other meeting going all the way to March of 2025. But look at it today. So this is this morning. You can see the huge shift in market expectations. Now they're expecting the first cut to happen in December of this year, and then just one cut after that. And just go back 6 months and it was just cut after cut after cut. So clearly markets have come round to the idea that inflation is now stickier and we shouldn't expect the Fed to start cutting anytime soon. And that was pretty much the policy message that we heard in the press conference as well. If we look at the change in language, it's always interesting to look at the Fed statement and see how it changes between meetings. They say that economic activity is continued to expand at a solid pace, so no big change in language there. In recent months, there's been a lack of further progress toward the committee's 2% inflation objective. So they're acknowledging now that there's enough information about inflation to show that it's really seems to have reached a plateau and it's not falling sufficiently quickly towards its 2% objective. So clearly, they're acknowledging that fact, and we'll talk about what Powell said in a moment. But then he also, in the statement, they also say about the slowing pace of the balance sheet shrinkage. So they also what they also say is interesting. I think they talk about the maturity distribution. Oh, maybe not here. Okay. Another point, I guess, is that it was a completely unanimous vote. So everybody on the committee voted the same way, which is to keep policy where it was. It was interesting that at the end of the FOMC meeting, there was a question about how come you always seem to have very little dissent in the actual votes? And Powell said, well, if you read the minutes, you'll actually see that we do have a lot of dissent. It just so happens that when it comes to the vote, we tend to agree. So he likes the fact that there's a wide variety of opinions in the committee, and he says that's one of the strengths of the FOMC. So let's take a look at some of the comments. So in recent months, there's been a lack of further progress. That's a big change. And I think acknowledging that inflation is sticky is a big move for the Fed. Previously, they were just saying it was like a bump in the road. Now it's, okay, inflation is not falling. The committee does not expect it will be appropriate to reduce the target range until it's gained greater confidence that inflation is moving sustainably towards 2%. So they've always said, in order to get a cut, they're going to have confidence that it's moving towards the 2% target. They haven't got that confidence. Clearly, the data has shown them that it's not happening. So hence the shift in tone, I guess, which is more hawkish, more towards less towards easing and more towards keeping it where it is, which is relatively hawkish. Beginning in June, the committee will slow the pace of decline of its securities by reducing the monthly redemption cap on Treasury securities from 60 billion to 25 billion. So those are the big changes, I think. And I like to take a look at the colour of Powell's tie, because I always think that's a kind of clue. This is his hawkish tie, and this is his dovish tie. And today he went for dovish, so take from that what you will. The balance sheet, I think, is an important one. So 60 billion a month to 25 billion a month. And if we look at the reason for it, I think that's really interesting, because what they say is this reduces the possibility that money markets would experience stress. This is one of the justifications for slowing the pace of runoff. Why would that be? Well, the thing to bear in mind is that if the Fed is kind of the real problem from the point of view of money market funds is getting their hands on risk-free debt. And for a long time, there was a shortage of treasuries, and that caused a real problem. And if you looked at something like the Vanguard money market fund in the United States, a huge proportion of its bonds, treasuries, were obtained from the Fed directly via repo transactions. So clearly the market for treasuries is strongly affected by this huge buyer and holder of US debt. So if it affects the supply and demand of those treasuries, it can hugely disrupt this really safe market, which is the money market in the United States. And clearly they're very careful not to do that and not to cause a hiccup in what should be a super safe market. Because if you look at where the Fed intervenes, one of the things in which it intervened in the huge crisis that we got during the pandemic sell-off, one of the prime places where it intervened was in the money markets, trying to stabilize them. So clearly it's sensitive to this runoff distorting that treasury market and screwing up the money markets as a result. So that's one of the reasons why it's slowing down the rate of balance sheet runoff. If we look at the size of the balance sheet now, you can see that with every round of QE following the financial crisis, it sort of ballooned up to about 4 trillion after the GFC and all the rounds of quantitative easing after that. And then with the pandemic, it increased to about 9 trillion. Now it's fallen by about 17% from the peak, and it's currently running at just over $7 trillion. So what we'll expect to see from June onwards, June the 1st, is that the slope of this graph will start to flatten out slightly. And really, I think the way Powell phrased it, he doesn't see that as distorting the monetary policy which they've got in place. It's still going to be very restrictive, but it's certainly going to affect the Treasury market significantly. So now let's move on to the press conference and some of the highlights, which I think there were. So the point about the first quarter being one of strong economic activity, it's still the case, I think, that the US economy is in pretty good shape. Growth is strong, demand for labour is still strong, but not as strong as it was. And we now have had 3 inflation readings, which were toppy, and which pretty clearly showed that inflation is not falling as quickly as they'd like. So his point is, how many inflation prints does it take to be a proper signal? And he's saying, so I think you're at a point where you should take some signal. I think we don't like to react to 1 or 2 months data, but this is a full quarter. And I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is it's likely to take longer for us to gain confidence that we're on that sustainable path down to 2%. So this is why they're holding rates where they are. And until that changes, and until we start to see inflation falling again, they're unlikely to shift policy from where they are now. What was also interesting was he talked about parts, and this is something new. I haven't seen this before, where one question he kind of batted away saying, look, I don't like to talk about hypotheticals. But then he himself came up with 3 hypotheticals. 2 of these paths would be paths to lower rates, to cuts. One of the paths, the top one you can see here, was to keeping rates the same. None of the paths, it has to be said, were a path to higher rates, which is interesting. Clearly that's not something they want to contemplate at the moment, or for kind of Fed watchers to contemplate at least. So what kind of path would be one where they would actually keep rates where they are? Well, that's pretty much a central case. Labour market remains strong. Inflation's moving sideways, like it is now, and we're not gaining greater confidence. So in that case, they're going to hold off on rate cuts. So that's where we are now. What would lead them to cut rates? Well, one path would be they gain greater confidence that inflation is moving sustainably to 2%. In other words, inflation starts falling, clearly. Another one would be if there's a weakening in the labour market. And in later questions, he actually said, a 0.1% increase in unemployment wouldn't do it. They'd have to see a substantive increase in the unemployment rate in the US. So at that point, they'd step in and try and stimulate things and ensure that there wasn't a further deterioration in the unemployment market in the US, in the employment market in the US. So I think one of the things to watch might be the SARM rule, which looks at the rate of change of unemployment. And that's a kind of GDP, it's a recession indicator, a real-time recession indicator that works really well, created by Claudius SARM. So that might be something to watch, to see if we've got that substantive deterioration in the labour market. I'm sure they'll be looking at that amongst other indicators, but that could be one to watch because that gives you a real-time indication of whether the US economy is really running into trouble and whether we're going to get a recession. If that happens, then a rate cut is almost certain to happen, I think, if it triggers the SARM rule. Another point is about the next policy rate. He says it's unlikely to be a hike. So why is he saying that? Well, he says our policy focus is really what I just mentioned, which is how long to keep policy restrictive. So what they didn't talk about, apparently, was raising interest rates. It's simply a matter of how long do we keep it where it is. The general consensus in the FOMC is it's sufficiently restrictive, but how long should we keep the pedal on the metal, really trying to slow down inflation? So what would it take? You would need to see persuasive evidence that our policy stance is not sufficiently restrictive, i.e., I guess inflation would actually be rising significantly to bring inflation sustainably down to 2%. That's not what we think we're seeing, but that's something like that is what it would take for them to hike. So far from it at the moment, but it's always possible. And there was an interesting question about stagflation, and he had a great one-liner. He said, I don't see the stag or the flation. And he pointed out he was around when the US had stagflation, and they had 10% unemployment, they had double-digit inflation, and they had zero growth. Well, if you look at GDP growth in the US right now, okay, it wasn't amazing, the last print, but it's running at about, the same kind of levels that we saw pre-pandemic. The pandemic is distorting all the macro graphs at the moment. You had a huge downswing, a huge upswing following it. But now we've pretty much gone back to that steady state that we saw previously. So stagflation is still a long way from where the US economy is right now. So you can bet you're going to see articles about stagflation in the coming months. But I agree with Powell here, which is that the US is far from it right now. There was a question about the upcoming election. So if there is an election, of course, it could cause an economic dislocation, depending on what happens. But Powell pointed out that this is his fourth election, the fourth presidential election, which he's been chair during. And he said, read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. So that put that one to bed. And I thought that was very clear. And I think that's correct. I think you should focus on the economy. Of course, it's affected by politics, but in unpredictable ways. And it's not really their job to try and guess which way the politics is going to go, who's going to get elected, or what the effect would be on the economy, which I think is very difficult to predict anyway. So let's take a look at that inflation number, because I think it is interesting to look at the inflation numbers which have caused all this grief in the first place. If you actually look at US core inflation, that's the yellow line here, notice how it is coming down. So CPI inflation is coming down. CPI core inflation is coming down. But if you look at CPI headline inflation, it's just kind of bobbing along at around this 3.5% rate, maybe 3.2 to 3.5. And that is worrying. If we look at the components of inflation, you can see that we've gone from the annual, so let me just show how this works. Annual price changes for the components on the left, and then monthly changes on the right. And for example, you can see that gasoline is starting to push back up. That is affecting transportation services. It's affecting electricity prices. There are still some prices which are going down. Used cars and trucks still going down month on month. Fuel oil going down. But notice how many of these components are now positive month on month. And that's worrying, right? So not all of these have an equal weight, of course. Shelter's a really important component and has a big weight in the CPI basket at least. And that was one of the other points, which is he thinks that shelter will have a decelerating effect on inflation. It will create disinflation later on, but there is a big lag, is his theory. If that's the case, then that could help push down inflation later this year, which is what Powell expects will happen. But this is the measure which the Fed actually looks at, which is personal consumption expenditures inflation. And you can see the yellow line is core. The blue line here is headline. And notice how for the last three prints, well, for the last two prints for headline, it's gone up. For core, it's kind of stabilized. It not really, the rate of fall of the rate of inflation has slowed down. So there's no clear disinflation. And, you know, we're not huge distance from the 2% here, but it isn't closing the gap. And that's what's worrying the Fed. But if you compare this to a lot of the rest of the countries in the world, the Fed's in a pretty good place and the US economy is in a pretty good place. And of course, you know, if you look at durable goods, they're already kind of bobbing along at zero. They're no longer pushing down headline. It's the services inflation which is sticky, unfortunately. But inflation expectations remain anchored. If you look at the 5-year ahead 5-year inflation rate, that's pretty much stabilized at 2.4%. So that, you know, the Fed is still credible. If you look at business surveys, if you look at household surveys, people still have faith that the Fed can get inflation back to 2%, which is reassuring. So I think I'll stop it there. Actually, we won't just have lots of slides, but overall, I'd say my take is, yeah, bit of a surprise on the balance sheet shrinkage. You know, the particular way they chose to do that. Interesting that they don't want to disrupt the money markets, and that's the reason why they've slowed it down. And I think now this is going to have big consequences for other central banks, like the Bank of England, which I'm covering this week as well. They're going to have difficulty now, because if the Fed's going to keep rates high, they can't really afford to cut, because if they do, that could disrupt their currency, for example, and that could indirectly weaken their currency and actually create pass-through inflation indirectly, which would be counterproductive. So when the Fed keeps rates high, it kind of encourages other central banks to do the same, even though they shouldn't. Strictly speaking, they should just look at their own knitting, you know, look after their own knitting and not really care about what other central banks are doing. But in the real world, you kind of have to be aware of that. So I think this could have consequences for the other central banks. And it'll be interesting to see if the Bank of England mentions that in its own statement. But so at this point, we will have a break while you think of questions. Let me just quickly mention the Bank of England is going to be next Thursday, 6 p.m. UK time. It's not this week. It's going to be next Thursday, 6 p.m. UK time. So earlier than this one, clearly, because we don't have to wait for the Fed and the time difference. There isn't one. And we have our regular first Thursday in the month Q&A tomorrow. So that's the one we've got tomorrow if you've just got general investment questions. And that's, of course, the 2nd of May at 7 p.m. UK time. So that's tomorrow. A regular Q&A, 7 p.m. UK time. Bank of England next Thursday, 6 p.m. UK time. And don't forget to like and share, is what my document says. So I won't get that wrong. Otherwise I'll be in trouble. So at this point I shall summon the Ted. It takes a little bit of time. So Laura hears this stuff with a lag. But apparently Teddy doesn't. He stays in her office and whines until he gets some of this stuff. Oof. There you go, mate. How's that? Is that good? You're going to do a trick. You're going to stand. You're going to show him how you can stand. I wish you could see him. He's learned how to roll. He's really good at that now. So I can get him to roll one way and then roll the other way. It's very cute. You can shake hands. You can do twist and turn. You're very good. One more. And you go back to Laura. There's a good boy. There's a very waggy tail down there. You can't see that. You're going to go back down to Laura. You go back to Laura. You get the biltong. Yeah. He's listening. Listening for the biltong rattle. Can we hear it? Can you hear the biltong? Yeah. Thanks, Dad. There's no thanks. Right, so he's got his biltong. Please do ask a question, and if you are one of our supporters on YouTube, we'll push you to the front of the queue. If you do a super chat, obviously we prefer that, and we'll push you to the front of the queue as well. and you'll pop up in this document which Laura's got for me, and I'll answer your questions. So what have we got? Do we have any questions? Evening, Peter Rasmussen. Evening, Shimster IOM. Blue Mousy. Hello. And what have we got for questions? So, interesting one from Rio Carl. He says, as global ETF investors, we focus on geographical distribution. But what about sector allocation? Some global ETFs are more focused on tech, while others concentrate on finance. How do we decide? Well, Amir, thank you very much. Super chat. Thank you very much, Amir Ketobchi. Very grateful. And that was a super chat. No question, it seems. He just says, keep up the good work. Thank you. Thank you, Amir. And but I think the point about tech is an interesting one, because what the US is party trick. You know, the US, it's really been the decade of the US over the last, since the global financial crisis. And the success story for the US has been tech, of course. And we've gone from a world where tech was a bit of a damp squib after the dot-com bubble imploded. But then eventually the US worked out how to build these internet businesses, make them profitable, and also to scale rapidly. And then we got these super success stories of companies like, Apple, Microsoft, Google, and Netflix, where they had an internet business which they could scale and become globally dominant, and essentially scale across the world. And it's the only country which has really managed to do that. And I think it's partly to do with politics, interestingly. I think the US is more palatable for the West than, say, for example, if it was like, as we've seen with TikTok, if that scales globally, suddenly it becomes a security concern. But if we have US tech in the UK, for example, and in Europe, because it's an ally, we're kind of cool with that. And the people who are rich generally are allies of the US. So, I think from that point of view, the US was very well placed. It has rich allies where it can scale into their markets without a huge amount of pushback. Whereas China, to scale in the same way, has closely tied economies, but they tend not to be so wealthy in those tied economies. So, I think the US is at an amazing advantage there. But there comes a point when it saturates that market. And I think we kind of got there for things like iPhones and things like Facebook. Only so many people exist on the planet who can check their Facebook profile and look at ads as they do it. So, we're kind of getting to the saturation point where the growth is slowing down in tech. And, Nvidia, even that narrative has started to dissipate slightly. So I think tech is still dominant. It's still very much a US story, and I think it's still very profitable. However, the rate of growth of tech has slowed down, because this inevitably happens. The US becomes even more dominant than it has been on average since 1920, where it's been 50% of equity markets. It reaches that 70% point of markets, and then something happens to push it back. And I think at the moment what's pushing it back is that it's just not growing as quickly as it was. And it's failed to come up with a new narrative after AI to push valuations even higher. And we've started to see valuations come back to reasonable levels for companies like Tesla, where all of the hype that was surrounding those stocks has been kind of frozen by the cold reality of earnings growth, which hasn't matched expectations. And really that's what it comes down to. Can you grow your earnings fast enough to justify huge returns? So I think, tech, probably, this is my call. Okay, I'm going to make a prediction. I think tech has kind of peaked, I think, and I think the US has also peaked for this cycle. And I think probably from here on, it's going to be much harder for the US to, generate the kind of returns we've been seeing for the last 3 or 4 years after the pandemic and the huge rally that we saw following the big sell-off in 2020. The monetary policy is more restrictive. The growth rates have slowed down. The cost of growing, the cost of capital has increased. And, the venture capital companies are no longer throwing money at tech companies. So the rate of innovation slowed down. So this whole kind of engine of growth in the United States hasn't stopped. By no means has it stopped. It's just come back to kind of like a mature rate of growth and a sustainable rate of growth, or closer to a sustainable rate of growth. And that means that someone else will probably step into the breach now. Who knows who that's going to be. But I suspect that that's going to be the case. And that means that the US probably will go through a period of poor performance, or maybe even underperformance, although I'd be surprised by that, given the profitability of US tech companies. But what I'd expect to see is something else coming up and bubbling up, some new form of tech, some new form of some new industry that we just can't predict yet. But that's what I expect will happen. But yeah, I don't think it's going to carry on as it is. But would I kind of go underweight the US right now? Probably not, because I don't think it's going to happen anytime soon. It'll probably be a slow process. And, there isn't a contender to take the US's crown at the moment. So maybe what we'll see is a kind of sector composition which tilts more into the physical. So, for example, the UK is big on energy. We have a lot of energy exposure in the UK. And if we see energy prices start to increase again, that would favour the UK rather than the US, because we don't have any tech in the UK, but we have a lot of energy. So, perhaps that's going to be it's finally going to be a tilt towards value rather than growth. The long-term pattern that we've seen for 100 years will resume. Value stocks will do better. And value at the moment, in fact, let's take a quick look at value right now. Finviz Sector PE is what I'm looking for on Google. And, it worked. Right. So, Finviz Sector PE, and this is what I get. Let me just maximize this. So what this does is it gives you the price to earnings multiple. The forward price to earnings multiple is what I'm going to look at across sectors. So let's see the cheap sectors. Energy. So nobody likes energy anymore. Financials, banks, not very sexy. Basic materials, stuff, utilities. All of these boring sectors, some of them are defensive sectors, are still reasonably priced in the US. Small caps, another surprising sector that's very cheap in the US. Whereas tech, industrials, consumer defensives, healthcare are all much more expensive. But the one which really stands out is technology at a 23 times forward multiple. Or if we look across countries, well, yeah, China's really cheap. So if you're very brave, you could say, well, I'll tilt towards, the countries which are looking cheap right now. Of course, they're always cheap for a reason. And so that's why it's brave to buy cheap stuff. So, in terms of sectors, those sectors are cheap. Maybe those are the ways to tilt. But personally, I don't do sector tilts. I just have one fund. And I don't do geographic tilts. I have a fund portfolio. And the tilt I've got in that, the geographic one, is for the UK. I'm neutral on sectors. I've tilted to small caps in the US with my fund portfolio. What else have I got? Yeah. And then I've got a global growth tilt via Scottish Mortgage because that was cheap. And I've got a bit of Tritax Big Box. So you can see it's a real mishmash of stuff which I'm just trying out. Interestingly, recently I've also bought the NASDAQ covered... what have I got? I've got the NASDAQ Yield Enhanced Fund, QYLP, which is the UK version of QYLD, the NASDAQ covered call ETF. And the idea here is that it generates a dividend of about 12%, which is paid monthly. And what I've done is I've set up a pie on Trading 212, which automatically reinvests the dividend back into the fund. So it's become a kind of accumulation fund, even though the individual ETF I've bought is an income fund. So every month I'm going to own a 12th more of that fund forever. So that's kind of cool. Of course, you keep all the downside, but that's just another experiment I've got in my fund portfolio at the moment. Just thought I'd share that. But my overweight, if I had to have a geographic overweight, is the UK at the moment, and really I don't have much of a sector overweight. If anything, it's tech, because I've got that Nasdaq covered call ETF. Brilliant. So let me just go back to your super chats. We have got some now, thank you. So Rio Carl did a super chat. He said, what do you think about buying a 20-year bond ETF like TLT? If interest rates fall, this ETF could perform well, right? Do you think this sector is currently undervalued? Well, I mean, what would it take for TLT to increase in price? Well, for it to increase in price, yields would have to fall at the long end of the US curve. What makes yields fall at the long end? Well, falling inflation. That is what I expect personally. So I think that would be positive for TLT. If growth falls, that's also positive for TLT because it pushes yields down and pushes prices up. That's not what I expect. I really don't see much evidence that the US economy is weakening. Like Pal said, I don't see the stag or the inflation right now. So if anything's going to push down yields, I think it's inflation falling, if we get US disinflation. But growth, I still think, is holding up pretty well in the United States. So it's immaculate disinflation, what some people have called it. No big pickup in unemployment, but inflation's falling. So would I buy TLT right now? Probably because of the inflation call, not because of growth falling in the US. Am I convinced that's going to happen? Not really. I wouldn't take a big punt on duration in the US at the moment, because let me just show you what TLT looks like and the reason why I'd be a little bit hesitant to buy it. So here is TLT. So yes, you're absolutely right. It's fallen dramatically. It's fallen about 50% over the course of 3 years, 2 and a bit years. But notice how volatile it is. This is looking like a stock index. So if you're going to hold fixed income, you always think it'll be kind of safe. Well, TLT isn't. It's very volatile. But do I think the only way is up? No. I think it could well be the case that inflation spikes again. What if we have an energy surge again? Well, inflation will spike and the price of this will fall. Or growth could actually recover and grow even more. We could have an acceleration in US growth, in which case, again, that's bad for this fund. So I think, personally, I think it's not such a clear direction that I can see for TLT and for US yields that would convince me that it's a huge buy at the moment. If it was the case that I expected weakening growth in the US at the same time as inflation's falling, i.e. a move towards stagflation, then yeah, I think it would be a great call. But at the moment, I think, growth is not really pushing the needle from my point of view, and inflation, disinflation kind of is, or will do, I think. But would I buy it at the moment? Well, funnily enough, it is in my fund portfolio. I've held long duration US treasuries for a long time now, and I'm making a loss at the moment. But, that was my thinking. After the crash, I thought, well, yields will probably pick up. Yields will probably fall from here. But it hasn't really happened. Not yet. But it's not a big bet. I just took a little punt on it months ago. I think it was over 6 months ago. And I'm making a loss. But yeah, interesting idea. But personally, at this point, I probably wouldn't do it. Certainly not do it again. I wouldn't buy more of it. Brilliant. So back to your questions. Let me just remind you again, we've got a live Q&A tomorrow, 2nd of May, and that's at 7 p.m. And we've got Bank of England next Thursday at 6 p.m. So we're going to cover that. And please do like and share. That's just reading the document. Billy2049, thank you for your super chat. Very generous. He says, what are your thoughts on Vanguard VHYG Global Fund, where dividends are reinvested automatically? I'm 32 and trying to invest for the long term. Yeah, well, clearly the one fund I own in my core portfolio, which makes up 90% of my wealth, is in VHYG. So clearly I'm a fan of the fund. But let me just quickly show you VHYG and what it is, just in case people aren't familiar with it. So, oh no, that's the wrong one. Let me just get the right one. Here we go. And share and maximize. There we go. So there are two flavors of this fund. First of all, what is it, right? So this is the wrong one. Is it VHYG, did you say? Let me double check. If it's VHYG, it's not the one I thought it was. Oh, it is VHYG. Okay. So that's not the one I've got. VHYG is a high dividend one. Here we go. So VHYG is an all-world high dividend yield ETF. Now, if you're 30, I'm interested that you're buying this one because this buys stocks which pay out a high dividend. And usually this is the kind of thing that people would buy in retirement because they want to just have something which they can own and an income version of the fund which spews out cash payments into their brokerage account so that they can take it out of their ISA and spend the money. And the yield at the moment on this thing is about 3%. So if you invested 100k in this, it would generate 3k per year income, which you can then spend or reinvest if you want. But you know, it's kind of interesting that you bought that as someone who's in their 30s. Normally what people think of is total return. So if you're paying out a high dividend, remember, you're not able to reinvest that money back into your company and grow your earnings. So your capital growth will be slower as a result. So what I think people should focus on more is total return. You know, whether it's dividends or whether it's capital growth, you shouldn't really care. Both of them have the same effect, which is to make you better off. So personally, I don't focus on high dividend yield because what also comes with this is a style tilt and a sector tilt away from market cap weighting. So I don't know if we've got, let's see if they do that. Vanguard don't, unfortunately. But can you see how the US has a lower weighting than it does in a normal market cap weighted benchmark? Europe is slightly higher, I think. Asia Pacific is higher, and that's because more Australia primarily, and EM's about the same. But I think that the overall effect is to buy more of the cheap countries. So the UK has a weighting of 7.3, and Switzerland 4.4. So the cheap countries are the ones which tend to pay the high dividends. So indirectly what you're buying with this is a tilt towards value, because another measure of value is how many pounds or dollars of income are you paying per dollar to buy the stock. And another measure of cheapness is if the stock price is relatively small compared to the income it generates. So that's another measure of cheapness. You know, big income relative to the price, or small price relative to the dividend. That's the important thing. So you're also taking a style tilt with this towards value. So just make sure that that's what you want, because value has underperformed for a long time now. You know, maybe just be aware that that's indirectly what you're buying with this. It's not just about dividend. But VHVG is the fund I've got. Let me just show you that. And it's a developed world ETF, so it's not a global one. It's only developed markets, as it excludes EM. It comes in an income and an accumulation version. I've got the accumulation version. The income version is called VEVE, VEVE, and I've got the accumulation, which is VHVG. And the primary reason I like it is because it's cheap. You know, the fee's only 0.12, which is cheap on Vanguard's platform for a global index. Well, not quite global because it hasn't got EM, but that's why I went for it. So, you know, that's my choice personally for my investments. But yeah, I think, you know, high dividend for someone who's 32 may not be a good choice. Also because if they're paying a high dividend, the capital growth is going to suffer. But, you know, as long as there's capital growth, reasonable capital growth, which it has been for that fund historically, then the income is okay. You know, it's going to push up the total return if you have the accumulation version. But, you know, for someone who's young, you know, I think it's probably best to just go for a global fund rather than a high income one. In retirement, I can see why people would have that fund, but not when you're 30, 32. Next question is from Gavin Lawrence, who's done a super chat. Thank you, Gavin. And he says, mega cap earnings are 15% moves the new 5%. Okay. So clearly it's been pretty volatile for companies like Meta. You know, I saw this great tweet which shows someone throwing their copy of The Intelligent Investor into the bin, and they say smashed earnings from Meta, share price fell 10%. Tesla earnings disappoint, gains 10%. You know, it seems to make no sense. These huge market cap companies like Tesla and Meta are having these huge intraday moves, or intra-week moves, I should say, on earnings results. And, you know, it's surprising because, you know, mega caps don't usually move that much. So there's clearly something going on there in terms of surprises, or maybe liquidity even. You know, maybe these stocks aren't as liquid as they should be. And, you know, that might be a result of, you know, indexes distorting markets, possibly. You know, I've read one theory about that this week, which is interesting. There was a Rational Reminder podcast about how index funds reduce liquidity for these large caps, and that might be the reason behind these huge earnings reactions for mega caps. You know, maybe that's true, maybe. See if I can find who that was. Someone actually recommended it in the community. If you haven't heard about our community, we have a Slack channel, so you can chat with me and other members of the community, and people are posting all sorts of stuff on there now, which is really interesting. So let me see if I can find index. I'll see if I can. It was a Rational Reminder podcast, so that might be tagged. Yeah, here we go. Here we go. The chap's name is Michael Green, and the episode of the Rational Reminder podcast was Market Efficiency is Not the Question. And we, on our podcast, I should mention our podcast as well, Many Happy Returns, which I do with my co-host Michael Pugh. And we're doing one on dividends. I don't know if that's already been published, but it might be relevant to your question, Billy 2049. But yeah, maybe it's the case that these index funds are starving some of the liquidity from these large cap stocks, and that's what's causing these huge moves. The next question is from Matthew Dick, who says, what about buying yen, given the 30-year low? And this has been remarkable as well. If you look at the yen, say versus the dollar, that's the biggest currency pair. Now, this is usually a pretty stable currency pair, and people do the carry trade based on this, but clearly it's been so volatile recently they can't. Let me quickly share. Here we go. So this is dollar yen. So it's the number of yen you get for every dollar, and you can see how much it's been weakening recently. huge moves. And of course, the central bank of Japan has apparently been intervening, trying to stabilize the currency. That never ends well because it just can't buy enough usually. But yeah, it's been very volatile, to say the least. But you say, what about buying yen given the 30-year low? The thing is, the cause of the weakness for the yen has not gone away, which is the Fed's keeping interest rates. I kind of hinted about this earlier. The Fed's going to keep rates high. The Bank of Japan is the only central bank which isn't really raising rates aggressively, or hasn't. It's still very accommodative. And if you look at the interest rate differential, that's usually what drives currency. The currency with a low interest rate usually weakens. So the fact that the Fed has kept rates high, and if anything, said it's going to keep rates higher for longer, while the Bank of Japan's really dragging its feet raising rates, that's pretty much weakened the yen, I think. That's the largest driver behind it. But would I buy it now? Not unless they change their policy significantly or hint that they're going to do that. If the Bank of Japan suddenly said, oh yeah, we're going to start raising rates significantly, or, something that would signal that they're going to get tighter policy, or conversely that the Fed was going to start cutting rates to meet them, that might make me more likely to do that. But at the moment, I think I'll probably keep away. But look, we've been going for an hour now, so I think that's probably enough for everyone. And let me thank you all for joining us. And remember, we will be here tomorrow night. We'll be here at 7 p.m. tomorrow night. I have the same top on. And you can see Teddy again doing his tricks. And Bank of England next Thursday, 6 p.m. Don't forget, you can join our community. If you like our podcast, it's called Many Happy Returns. You can find it on your favourite podcast player. People tell us they enjoy it. I enjoy doing it. I think Michael does too. And we have a great time. In fact, you could probably tell. And do like and share this live stream. And thank you for joining us.